Welcome to the Deep Dive. We're Talk Tickers.
And our mission is simple. Cut through the earnings call noise and get straight to the signal.
Exactly. Today we're diving into Oriental Carbon and Chemicals Limited, that's OCCL. We've got their latest conference call transcript right here.
That's right, we're looking at Q4 and the full fiscal year 24. The goal, to pull out the key numbers, understand the market context they're seeing, and, get management's perspective.
Think of it as your quick way to get up to speed on OCCL, straight from the source.
Let's do it.
Okay, let's kick off with the numbers. How did Q4 look for fiscal 24?
So Q4 FY24, total income came in at 108 crore. That's actually up 4% compared to the same time last year.
Okay, 4% growth year on year, not bad. What about profits?
Well, EBITDA was 27 crore, which is up 7% year over year, and that meant the EBITDA margin ticked up a bit too, from 24.1% last year to 24.8% this Q4. And profit after tax, PAT, that was 13 crore. That showed, pretty healthy 15% growth year over year.
Wow, 15% on the bottom line.
Yeah, and the PAT margin also expanded nicely from 11.1% to 12.3%.
So a pretty solid finish to the year then, on a quarterly basis anyway. Revenue and profit both growing year over year.
Absolutely. And management made a point of saying Q4 was better than Q3 sequentially. They said it was mainly driven by higher volumes.
Right. That sequential pickup is definitely worth noting.
Mm-hmm.
Okay, so that's Q4. Now let's broaden out. How did the full fiscal year 24 shape up?
All right, full year FY24. Total income was 401 crore. Now, this was down about 14% compared to FY23.
Down 14%. Okay, that's quite a drop.
It is, but here's the interesting part. EBITDA was basically flat year over year, landing at 97 crore.
Huh. Flat EBITDA despite that revenue drop.
Exactly, which means the full year EBITDA margin saw a pretty significant improvement. It went from 21% in FY23 up to 24.2% in FY24.
That's a decent jump in margin. What about PAT for the full year?
Full year PAT was 43 crore, so only down slightly, about 2% from the previous year, and the PAT margin was 10.7%, just a touch lower than the 11.1% in FY23.
Okay, so let me get this straight. Full year revenue down significantly, but EBITDA held its ground, PAT barely dipped, all thanks to much better margins. Why was revenue down so much for the year?
Yeah, management addressed that directly. They said the 14% revenue drop was mostly because of lower sales prices.
Yeah, okay.
And those lower prices were basically reflecting their own lower input costs. Specifically, they mentioned lower sulfur prices for their insoluble sulfur and lower freight costs for their sulfuric acid compared to the year before.
Ah, I see. So they were selling cheaper because their costs were lower, but they managed operations well enough to protect or even boost those EBITDA margins.
That's the story, yeah.
Yeah.
Speaks to, some good operational control in what sounds like a tough environment.
Okay, that makes sense. And that leads us right into the market environment they described because, well, those full year numbers suggest things weren't exactly easy out there.
No, that's putting it mildly. They painted a picture of a really challenging global scene.
Like what specifically?
They mentioned, high inflation still being an issue in places, lower overall demand for chemicals, and because of that, depressed prices globally.
Right. The usual suspects.
Pretty much.
Yeah.
They also talked about the global chemical inventory restocking cycle winding down and just a general, quite pronounced slowdown across the whole chemical space.
Any specific regions they highlighted?
Yeah, Europe, it's their second biggest market, apparently.
Yeah.
They said demand there is sluggish, pointed to the macro situation, geopolitical stuff, the conflicts,
So Europe's weak.
They feel like it's maybe stabilized, but definitely not recovering yet, though, is the sense.
Okay, so weak demand is a big headwind, but what did they identify as the main challenge, the number one issue?
The single biggest thing they hammered home was excess production capacity globally. Just way more capacity out there than current demand can soak up.
Right, the classic supply-demand imbalance.
Exactly. And that's what's putting huge pressure on prices and margins everywhere. And crucially, they don't see this changing quickly. They think it'll stick around until things rebalance.
How does that global overcapacity hit them closer to home here in India?
Well, that brings us to the dumping issue.
Ah, dumping. Okay.
Yeah, because you've got players, especially in China and Japan, they mentioned, with all this spare capacity, they're exporting stuff into markets like India at really low prices.
Undercutting local producers.
Precisely. So OCCL said they've actually applied to the Director General of Trade Remedies, the VGTR, asking for anti-dumping duties on insoluble sulfur coming from China and Japan.
That's a big step, applying for ADD. Is it just China and Japan?
Well, they also mentioned another player, Flex has apparently started dumping recently too. OCCL said they're gathering the data and plan to go after them as well once they can prove it.
So this dumping, it really hurts their pricing power domestically, I assume.
Absolutely. It forces their hand. These super low import prices put pressure on what they can charge in India, hitting their own margins. That's why getting that anti-dumping duty is so critical for them right now. It's about trying to level the playing field.
Right, makes sense. So navigating this really tough market, what's the company doing strategically? And, how's their financial health looking overall?
Management talked a lot about being prudent with capital and focusing on paying down debt. They cut debt last year and apparently made more big repayments just this past April.
Okay, good financial discipline. What are the debt numbers now?
They gave specifics. Non-current long-term debt is 33 crore. And then current short-term borrowings, which includes the current bit of the long-term debt, that's 52 crore.
And cash. Do they have cash on hand?
Yep, they reported 63 crore in liquid cash and investments.
So debt seems manageable, good cash buffer.
Yeah, they summed it up by describing their balance sheet as healthy, which is, exactly what you want to hear when the market cycle is down.
Definitely. So with that healthy balance sheet, are they pushing ahead with big spending? Any major expansions planned soon?
Not really, no. For now, CapEx is basically limited to maintenance stuff and projects with a quick payback. They were pretty clear that the big phase 2 capacity expansion, that's on hold until their overall utilization gets much higher, like 85% to 90%.
Okay, discipline there too. What's utilization running at now?
Currently, it's around 70% overall, although they did mention their sulfuric acid plant is running flat out, full capacity.
Got it. Okay, let's shift gears a bit. There was some major corporate news. They discussed the demerger. What's the latest on that?
Right, that was a big piece. Good news mostly. Yeah. They've got the main approval from the NCLT, the National Company Law Tribunal, for the demerger scheme.
So it's a done deal. Approved.
Almost. Very close. The NCLT order got appealed, but only on one specific kind of technical point, the appointed date.
The effective date, basically.
Exactly. It's now with the appellate tribunal, the NCLT. The case is admitted, and management sounds like they expect it to wrap up pretty soon. They're just arguing to keep the date that was in the original plan.
So the actual demerger structure isn't really being challenged, it's just timing.
That's the impression, yeah. And they reiterated why they're doing it. The usual reasons: unlock value, let each business have its own focus, risk profile, make it easier to attract specific capital or partners for each bit. More flexibility, basically.
Makes sense. And their engineering business, Duncan Engineering, where does that end up after the split?
That's going into the investment company that gets created through the demerger. Management sounded pretty positive about it, actually. Said they expect growth there and are working on new products.
Okay, so looking ahead now, what did management say about their outlook? What are their expectations for the market and for OCCL going forward?
Well, this is where they sounded quite cautious. They were very direct about expecting this demand-supply gap globally to take a while to sort out.
How long is a while?
They described the gap as significant and only projected global demand growth for insoluble sulfur at maybe 3-4%. Because of that, they explicitly said normalization is not expected for at least the next 2 years.
Wow. At least 2 years. That's a long time. That really underlines that they see this as more than just a short dip.
Absolutely. And that prolonged overcapacity obviously impacts pricing and margins.
Right. What did they say about that?
They expect the next 2 or 3 years to stay tough on pricing, again, because of the global overcapacity and the dumping issues. For this current fiscal year, FY25, they're actually guiding for a 4-5% drop in margins per ton compared to last year, FY24.
A 4-5% margin reduction per ton. Do they think that lower level is sustainable?
They seemed to suggest it could be, especially if they get the anti-dumping duty put in place. They also kind of hinted that prices from places like China are already so low, there might not be much room for them to fall further, unless, raw material costs also fall significantly.
Speaking of which, what's happening with their raw material costs, like sulfur and oil?
They said sulfur and oil prices are stable right now.
Yeah.
But interestingly, they mentioned a sort of negative outlook specifically for sulfur prices, maybe suggesting they see potential for it to go lower.
Okay, so you've got these headwinds. A long wait for market balance, tough pricing, lower margin expectations. How does a company feel positioned to actually handle all this?
They expressed confidence, actually. They feel OCCL is well placed to ride this out. They pointed to things like the healthy balance sheet we talked about, the debt reduction, the demerger strengthening the structure, their ESG work, and importantly, their customer relationships.
So they think they're fundamentally strong enough.
Yeah, the message was basically, we're lean, we're financially sound, we have good relationships, and when demand does eventually turn, we'll be ready to ramp up utilization and efficiency quickly, maybe faster than others.
Okay, let's dig into a few more specifics that came up, maybe from the Q&A, just to add some more color. Back to the anti-dumping duty for a second. How does OCCL's own capacity compare to demand here in India?
Right, good point. They clarified that their own capacity, which is 39,000 tons a year, is actually way more than the total Indian demand for insoluble sulfur. They estimate domestic demand is only around 22,000 tons a year.
So the ADD isn't about blocking all imports then?
No, exactly. They stressed it's specifically about dumping the imports coming in at unfairly low prices that mess up the market, not about blocking legitimate imports.
Got it. And you mentioned sulfuric acid prices were down for the year. Why was that again?
Yeah, the realization, the price per unit dropped by 50%. Management said it was basically a direct pass-through because the cost of sulfur, its main raw material, also dropped by about 50% compared to the previous year. It did hit the contribution margin too, though.
Okay. What about in North America? Are they making progress there?
They said plans are in place, but it's interesting. The challenge isn't getting the product approved by customers. They said most key players have approved it.
So what's the holdup?
It's more commercial challenges, competing against the big, established U.S. supplier, basically. So they've got their foot in the door, but they admitted the volumes aren't where they want them to be yet.
Right. So they expect their own growth to be faster than that overall 3-4% global market growth, right? Where's that extra growth coming from?
Yeah, they do expect to grow faster. They're banking on the Indian market growing faster, maybe 8-10% for insolubles. Plus, they're targeting new regions and manufacturers they haven't sold to before.
Okay. And uses for insoluble sulfur. It's mostly tires, right? Anything else significant?
Primarily radial tires, yes. They mentioned it's also used in bias tires and footwear, but the amounts are really small compared to tires. Those smaller sales usually go through distributors, not direct.
And for those big tire company customers, what's most important? What do they look for?
Management listed the key things as quality, cost, and reliability. The big three.
Makes sense. What about value-added products? They used to talk about that. Is that still a distinct category?
Oh, apparently not so much anymore. They explained that what they used to call value-added, which was maybe 22% of sales back then, has kind of just become the standard now. They said all products are same now, meaning everything meets that higher standard.
Interesting. Did they hear about any new global capacity coming online beyond what's already known?
Someone on the call asked about a specific one, Saco chemical capacity. Management basically said, yeah, we know about that one, but we don't have info on any other major new capacity plans globally right now.
Okay. And with cash building up and CapEx limited, what did they say about using that cash? Any talk of buybacks or anything?
They kept it pretty general. When asked about cash flow strategy post-demerger, the response was essentially, we'll do whatever's in the best interest of the shareholders.
The standard answer. And lastly, are they still active in venture investments, despite the tough market?
Yes, they confirm they are. Still deploying capital each year into venture opportunities and still finding things they like.
So, okay, let's try and pull this all together. What does this deep dive into the OCCL call really tell you? I mean, it paints a pretty clear picture, doesn't it? You've got a company that seems fundamentally well-run, good balance sheet.
Right, the core seems solid.
Yeah, but it's smack in the middle of a really tough cyclical downturn in its main market. And that downturn isn't about them, it's macro. It's driven by this huge global overcapacity problem, which leads to weak pricing and dumping.
Exactly. That's the environment.
Yeah.
So it's less about OCCL messing up and more about them needing to navigate these external storms.
And their response seems to be batten down the hatches. Financial discipline, strategic moves like the Demerger, fighting back with the ADD petition.
Precisely. They're playing defense, managing costs, strengthening the structure, protecting their home turf. They're positioning for the eventual recovery, but they're being very realistic, maybe even a bit pessimistic about the timeline, saying at least 2 years for normalization is pretty stark.
Yeah, it is. And that anti-dumping outcome feels really key in the near term.
Definitely one to watch.
So this deep dive into the OCCL earnings call shows a company facing serious headwinds over capacity, dumping but responding strategically. Healthy finances, the demerger moving forward, but a clear warning that the market recovery could take 2, maybe 3 years.
Okay, quick reminder. This is not financial advice. We're just dissecting the call here. Now, for a final thought to chew on. Management clearly expects this tough period, this supply-demand imbalance, to last at least 2 more years, and they're guiding for lower margins because of it. So the provocative question is, what are the absolute critical signs you'd need to see maybe in global data, maybe competitor actions, maybe even OCCL's own metrics that would signal the cycle might actually be turning earlier than they expect? And how would those early signs likely show up specifically for OCCL? Something to think about.
We really hope this breakdown of the earnings call gave you some valuable takeaways. Remember, you can always go read the full transcript yourself for even more detail.
Thanks for tuning in to The Deep Dive. We'll catch you on the next one, breaking down another company transcript.
Until then, keep digging.